pen in your hand isn't a tool for buying a car, it's an extraction needle. As you sit in that windowless finance office, exhausted after 4 hours of calculated delays, the finance manager slides a mountain of legal paperwork across the desk. They smile, point to the signature lines, and assure you it's just standard regulatory boilerplate. It's a lie. That contract is a legally binding trap designed by corporate attorneys to bleed your bank account dry. You think you're purchasing a vehicle for $24,000. In reality, the algorithmic financing software has already locked you into a $31,500 debt obligation. The extra $7,500 didn't go toward the car. It was skimmed into a black hole of back-end interest rate spreads, mandatory digital add-ons, and artificial fees. Dealerships do not view you as a customer. They view you as raw financial data to be mined, processed, and discarded. If you walk onto a dealership lot without knowing their hidden structural math, you are walking straight into a financial slaughterhouse. Modern car buying is an asymmetric psychological war where your brain completely stops evaluating risk just to escape an uncomfortable environment. Quiz time. A dealership presents a loan contract where the Tier 1 lender's approval is legally structured as a conditional delivery. The finance manager states that federal lending guidelines require you to purchase a Guaranteed Asset Protection (GAP) policy to satisfy the debt-to-income (DTI) ratio for a zero-down loan. What is actually occurring? A. The lender has triggered an automatic underwriting override that requires localized asset insurance. B. The dealer is committing a deceptive trade practice by misrepresenting a high-margin voluntary product as a mandatory lending requirement. C. The Truth in Lending Act, TILA, mandates gap protection on all financed vehicles exceeding 90% of the loan-to-value LTV ceiling. Drop your answer in the comments. Let's see who actually understands consumer credit law. Scam 1. The four-square matrix deception. The correct answer is B. It is completely illegal under the federal Magnuson-Moss Warranty Act for a dealership to claim that a third-party loan approval is conditional upon buying an extended warranty or any other back-end product. This brings us directly to scam number 1, the four-square matrix deception. This is the foundational psychological weapon used by sales managers worldwide. When you sit down, the salesperson will draw a large cross on a blank sheet of paper, dividing it into 4 quadrants: trade-in value, vehicle price, down payment, and monthly payment. This sheet is designed to bypass your logical brain by functioning as a shell game. If you aggressively demand a lower purchase price, the sales manager will gladly grant it to you in the top right box, while simultaneously slashing your trade-in value in the top left box, or quietly extending your loan term from 60 months to 84 months in the bottom right corner. They shuffle the numbers between the squares like a magician, keeping your eyes entirely focused on a low monthly payment while the true total cost of the credit explodes. Next, we are exposing the predatory addendum trick, an undercover tactic where dealers add thousands in pure profit to the car's window sticker before you even open the driver's door. Quiz time. When a salesperson asks you, what monthly payment are you looking to stay around, what is the safest strategic answer you can give? A. Give them your exact maximum budget target, for example, $450 a month. B. Tell them you are only negotiating the out-of-the-door total price today. C. Say you haven't thought about it yet and ask what they recommend. Think carefully before you answer. Your response dictates the entire financial trajectory of the deal. Scam 2. The pre-installed addendum extortion. The correct strategy is B. The moment you utter a specific monthly payment number, like $450, you have completely lost the negotiation. This shifts us directly into scam number 2. The pre-installed addendum extortion. You do your homework, negotiate a clean price online, and walk into the building to finalize the transaction. But when the buyer's order sheet is printed, you spot an extra $2,995 tacked onto the bottom. The dealer will claim this is for mandatory dealer-installed options, like nitrogen gas in the tires, ceramic paint protection, vinyl pinstripes, and a GPS recovery tracker. When you demand their removal, the sales manager will look you in the eye and say, "We can't take those off. They are already physically applied to the vehicle and hard-coded into our inventory management system. Every customer must pay for them." This is a bold-faced lie designed to exploit your emotional investment in the vehicle at the final second. If a dealership advertises a specific vehicle price online but refuses to sell it without mandatory unadvertised add-on fees, they are engaging in illegal bait-and-switch advertising. Quiz time. When a dealership flatly refuses to remove a $2,000 pre-installed dealer accessory fee, claiming it violates their corporate uniform pricing policy, which legal or tactical response carries the highest leverage for the consumer? A. Filing an immediate bait-and-switch advertising complaint with the state attorney general while remaining at the showroom desk. B. Offering to pay the dealer's verified wholesale cost for the physical accessories rather than the retail markup. C. Telling them you will walk away from the deal unless they discount the vehicle's base price by that exact same amount. Decide your move. The next 30 seconds will determine if you keep your cash or hand it over. Scam 3. The dealer interest rate spread. Skim. The correct tactical answer is C or A. If they truly cannot physically remove a spray-on ceramic coating from the vehicle, that is an internal operational cost for the dealership, not a financial obligation for you. This highlights scam number 3. The interest rate spread skim. This is the single largest, most lucrative quiet profit center in the entire automotive retail industry. When you submit your credit profile to the finance department, they send it through an automated platform to multiple financial institutions. A lender reviews your pristine credit and returns an approval at a 5.5% interest rate. This is the buy rate, the actual cost of the money. However, the finance manager is under no legal obligation to tell you what the bank actually said. Instead, they walk out with a typed sheet showing an approval at 7.5%. They have quietly added a 200 basis point markup to your loan, skimming the entire difference as pure, unearned dealership profit over the next 6 years without you ever realizing it. Up next, we are breaking down the absolute most terrifying scam in the industry: yo-yo financing. This is a brutal trap where the dealer allows you to drive the car home, only to call you 3 weeks later demanding more cash. Quiz time. How can you completely eliminate the dealer's ability to mark up your auto loan interest rate before you ever set foot on the lot? A. Bring a signed printout of your latest personal credit score. B. Secure a pre-approval letter directly from your own credit union or bank. C. Threaten to sue them if they try to change the bank's base numbers. Lock in your strategy. This one move saves the average buyer over $2,500. Scam 4. The spot delivery bait. The correct answer is B. Securing an independent, outside pre-approval from a local credit union completely strips the finance manager of their rate-marking leverage. This transitions us straight to scam number 4. The devastating spot delivery or yo-yo financing trap. It happens exactly like this. Your credit isn't absolutely perfect, but the finance manager smiles, shakes your hand, and tells you that your loan is approved. They have you sign a mountain of paperwork, hand you the keys, and let you drive the shiny new car off the lot. You spend the next 2 weeks driving to work, showing it to your neighbors, and completely falling in love with the vehicle. Then, on a Friday evening at 5 p.m., your phone rings. The finance manager coldly informs you that your auto loan application was officially rejected by the bank's underwriting system, and you must return the vehicle immediately or face auto theft charges. They intentionally let you take the car home so that you would become emotionally attached to it before changing the terms. Quiz time. When a dealership lets you drive a vehicle home before receiving an official written loan sign-off from an outside lender, what specific legal clause have they hidden inside your paperwork to protect themselves? A. A statutory right of rescission under federal banking laws. B. A bailment agreement or condition delivery addendum. C. An implied merchantability waiver authorized by the Uniform Commercial Code. Drop your answer in the comments right now. This single legal clause is used to completely strip you of your consumer rights. Scam 5. The trade-in ACV shell game. The correct answer is B. When you sign a spot delivery contract, you are signing a bailment agreement, which states that the dealership is simply loaning you the vehicle temporarily until your financing is finalized. If the contract is voided, they must return your trade-in asset immediately. This connects directly to scam number 5, the trade-in ACV shell game. A CV stands for actual cash value, and it is the real wholesale dollar amount the dealership can get for your old car at an auction. Dealerships know that buyers are highly emotional about the value of their old vehicles. If you insist that your old car is worth $10,000, even though its true market value is only $7,000, a predatory sales manager will easily match your $10,000 demand on paper. They will make a big show of celebrating your victory, but behind the scenes, they will simply add that extra $3,000 difference right back into the purchase price of the new car you're buying. Coming up next, we are exposing the doc fee stuffing routine, a quiet corporate fee added to the final printout that they claim is mandated by state anti-discrimination laws. Quiz time. If a dealer offers you an uncharacteristically high price for your trade-in vehicle that is far above its actual wholesale value, where are they most likely hiding that extra cost? A. They are absorbing the financial loss as an authorized tax write-off. B. They are quietly inflating the purchase price of the new vehicle or adding high interest rate markups to the loan. C. They are using federal clean energy credits to subsidize the transaction. Evaluate the numbers carefully. Scam 6. Electronic doc fee stuffing. The correct answer is B. Treat the trade-in as a completely separate financial transaction by securing outside online cash offers before arriving. This protects you against scam. Number 6. The electronic documentation fee stuffing routine. You've negotiated a clean price, secured your outside financing, and handled your trade-in flawlessly. But when the final invoice prints out, you see a line item labeled documentation fee, doc fee, or dealer administrative fee, priced anywhere from $499 to an astronomical $1,199. When you object, the finance manager will sigh and say, "I'm sorry, but that fee is completely non-negotiable. It is hard-coded into our system by our corporate compliance department and by state law. We are required to charge every single customer the exact same fee, or we could be sued for discrimination." This sounds incredibly official, but it is a highly calculated half-truth designed to lock in an artificial back-end margin. Quiz time. While a dealership may be legally required by state anti-discrimination laws to charge the exact same doc fee line item to every buyer, how can you completely wipe out its financial impact on your wallet? A. Demand that the dealer pay your local state vehicle registration fees out of their own pocket. B. Demand an equivalent reduction in the actual sales price of the vehicle to offset the cost of the fee. C. File an immediate consumer protection lawsuit under the Fair Credit Reporting Act. Lock in your choice. Don't let compliance jargon scare you into paying an artificial markup. Scam 7. The payment packing routine. The correct answer is B. While they may have to print the line item on the sheet, they can easily drop the base price of the car by that exact dollar value to net it out to zero. Now we enter the ultimate ambush arena. Scam number 7, the invisible payment packing routine. During the initial negotiation on the showroom floor, the salesperson might quote you a verbal payment range, stating, "Based on your credit, it looks like your monthly payment will be between $510 and $540 a month." When you agree and walk into the finance office, the finance manager prints out a contract right at the maximum cap of $540 a month. They will present it as a massive victory. What they are completely hiding is that at the bank's actual interest rate, your true monthly payment should be exactly $498. They have deliberately stuffed a $42 monthly discrepancy into the loan principal to cover high-margin items you didn't ask for. Up next, we are stepping into the hidden back-end markup of gap insurance and chemical interior protectant packages that cost the dealer $40 but cost you $1,500. Quiz time. If a finance manager tells you that a $540 monthly payment includes a complimentary maintenance and paint protection package, what has legally occurred inside the contract formatting? A. The dealership is absorbing the product cost via a manufacturer's volume discount program. B. The dealer has legally packed the cost of those products directly into the principal balance of the loan without your explicit itemized consent. C. The Truth in Lending Act automatically grants free coverage packages to Tier 1 credit profiles. Drop your answer in the comments immediately. Don't let the word complimentary blind you to the underlying loan balance. Scam 8 and 9. Protection insurance markups. The correct answer is B. There is no such thing as free inside a finance office. You're paying for it with compounding interest over the entire duration of the loan term. This maps directly to scam number 8, the hyperinflated gap insurance markup. And scam number 9, the third-party extended service contract trap. Gap insurance and warranties are valuable, but dealers buy them wholesale for $150 to $300 and mark them up by 400% on your menu, selling them for $1,200 to $3,500. Furthermore, these third-party service contracts are riddled with hidden exclusionary clauses in the fine print that completely disqualify the exact electrical components or touchscreens that break down most frequently. To completely bypass this entire layer of protection profit skimming, you should source your GAP protection directly through your auto insurance provider for pennies a month, and always insist on a factory-backed warranty over a third-party policy. Quiz time. When evaluating an extended vehicle warranty contract, what is the most critical structural phrase you must look for to ensure maximum component coverage? A. Inclusionary scheduled policy. B. Exclusionary bumper-to-bumper coverage. C. Stated component asset protection plan. Read the fine print. Choosing the wrong contract type leads to a denied claim when you need it most. Scam 10. The extended loan term squeeze. The correct answer is B. An exclusionary contract is completely superior because it automatically covers every single component on the vehicle except for a brief list of specific wearable items explicitly listed as excluded. This brings us to our final trap, scam number 10, the dangerous extended loan term squeeze. To make highly overpriced vehicles seem affordable to the average working-class buyer, dealerships are now routinely writing auto loans that stretch across 72, 84, and even 96 months. They will frame this as a major convenience, saying, "Look how low we got your payment. It's only $390 a month." What they are completely hiding is the compounding interest trajectory. By stretching a loan out over 7 or 8 years, you will remain trapped in a state of negative equity, meaning you owe significantly more on the loan than the physical car is actually worth for nearly the entire duration of your ownership cycle. Never exceed 60 months on a new vehicle or 48 months on a used vehicle. By keeping your loan terms short, securing outside pre-approvals, and negotiating purely on the total out-of-the-door price, you completely strip the dealership of their psychological weapons. You walk in as a predator and walk out with your wealth fully intact.